All right, good morning, everybody. How you doing? Today, let's start with an all-important update. Let's get to, what we need to look at. A lot going on today. Just want to check in with everybody. Let me get my stuff together. Big shout out to the chat. Let me check my levels here. There we go. How's everybody doing? Want to talk to everybody about just getting into the update after yesterday. Pretty much the Doge situation, and we see S&P 500 selling off yet again. So whole lot to discuss today. I mean, just continuation of what's going on. More of what's happening. Bear with me one moment. One moment. Here. Okay. Checking in. Great. Thanks, everybody. Next week I'll be back in full force, just kind of wrapping up this week and trying to get a little time away, but yet not able to, go away, and then we see the market just go bonkers. How's everybody doing in the chat? Thank you, David, Ritoshi, XYZ, Miss Stephanie. I'm doing my best. Hopefully it sounds okay. And again, I'm just trying to keep up with what I can do while on the road, and I'll talk more about that next week. But I do think we have to discuss, let's just look at S&P 500 really quick. We're down another 60 since that Gartley from back at the top in April. And I wanted to highlight something that is, a little difficult to see, but I've been looking at this chart to explain why this would be doing such a thing. And we had a really unusual type 1 reaction. And coming back, when we came back on that retest, it kind of was sneaky. And this is something I've been seeing in our algorithms that is helpful, but it would be difficult to spot just by the eye, is literally that sequence of hitting the target, hitting the pattern, and reacting to target one, and then having a kind of a stealth retest, if you will, down at the retesting XA level on S&P, and that really explains, as tricky as that was, that really explains why we're accelerating now and well under target one. Appreciate the comments. Thanks, everybody. Yeah, I'm a little bit better today. I think my microphone is scratchy. It could be me too. Thank you. I sound better, but for some reason my microphone doesn't. You know what? Let me do this. I think I've got my levels completely overmodulated. I can turn that down just a little bit. Let me know if that's any bit better. Probably that's it. But yeah, just normally I'm usually not affected by allergies, stuff like this, but boy, the last several days I've been not able to even breathe out my nose or speak, as you've been able to hear me, but I hope that'll be better. Yeah, the Doge thing, we'll get into Doge, because do look at yesterday's session and take a look at the 58-minute mark. That's where we covered Doge, and it pretty much did or is doing exactly what we talked about, which is went into the type 1, type 2. Sound is not very good. That's not good. That is not good. That's not what I want. Should I check my... Let me check. Thank you, guys. I appreciate it. It was better when the volume was higher. Maybe that'll be it. I don't know. You let me know. I'll turn that up. How about that? It just seems like between my voice and garbage, this microphone. But I can get done what I need to get done here today in about 30 minutes, and we'll circle back on Thursday. I'll be in a better spot. I do want to update, though, because this kind of continuation, folks, of what we're seeing. I was pretty adamant about what happened on Friday was a rather significant event, rather significant situation. Here you go. I think I got something. I know what it is. Great. I had that over. I think I had the volume too high. That was reverbing in the microphone. So now here we are on the verge of May, where everyone is supposed to sell in May and go away. But guess what? They're already doing it. And it's not what you want to see at these points. Again, another aspect of where we are in the whole market scenario is kind of more of a downside acceleration than any kind of constructive turnaround. That's why, as I've been saying, this is where the malaise starts to hurt. This is where you see a lot of your favorite stocks just continue to get dinged. And a couple people sent me a note on things like Netflix and other crazy calls. Netflix to go to $50. Let's really quick revisit that because, again, this is where the possibilities help to kind of clarify or at least keep us open to realities, to possibilities. And it's not fun, but this is the backside of the bull market. This is what happens when, bull markets fall apart, and they fall apart every 8, 10, 12 years, and they take about 15 to 20 months, and it's just devastation. Here's Netflix. Let's just revisit this because this is the breakdown. I think this is what's going to happen to Facebook, quite frankly, and I said that yesterday. We'll look at Facebook a bit more today, but just a quick revisit of that whole possibility. And even if it's look, we were arguing and saying, what if this is just an all-time shark scenario? Well, even this big 1618 that has to happen to satisfy the shark, it doesn't line up. All right, that was something that I did want to clarify, where you're not going to get a full shark alignment, but this is certainly something where all-time 886 is you know, with this kind of breakdown in action, it's not an opportunity. I know Bill Ackman. I don't know him personally, but I know that he took a monster position in Netflix on the first down leg and then sold it for about a $300-400 million loss. I think he bought that first dip and then he sold the rest when it crashed down. So obviously he's throwing in the towel. But I feel like that is the first of several to go. Look at Facebook, Meta, whatever you want to call it. I've been saying, yes, we have a pattern here, but it's failing. And it's failing because for two reasons. The way it entered into the zone with a massive breakdown at the 1618. The 1618 on Facebook was 244, folks. And where it went straight to the hop at 207, and there's just really nothing there. So you step aside, and one of the things that I said yesterday is that when your primary time frame fails, you kick up to the larger time frame. So if your daily fails, you go to the weekly. And the weekly, look, if we don't know anything about patterns and we're just looking at that price action, not much there. I mean, it's not that you're you're breaking into new lows for the year. And I think, again, another example of just a COVID full reset, 886. This is something that is going to be a theme, a technical theme, if you will, of paying for the COVID recovery. We went up in a massive surge. Now we're rolling back down the backside. With most of these that are fitting this scenario, we need to target 886 full reset, COVID full resets. And until you get down there, the market will not find a bottom. That's just the level of drama going on at this point. Yeah, it's an 80s voice stream. I tell you, it feels like my voice is like 80 years old right now. Not sure why this is so. What's going on with this? I actually am probably getting some feedback on the volume. Hold on. Don't even have my right headset. All that. Hold on one second. So with a lot of these, a lot of the scenario going on in these situations, um, you're going to just wait these out. And again, if anyone's saying there's an opportunity here, not until we go back and retest these COVID lows. Yeah, there's a lot of other levels. There's moving averages. I know a lot of people are looking at 50 and 200-day moving averages on stuff like S&P, but a lot of those aren't in any position. For Meta, Facebook, I'm going to keep calling it Facebook. I'm not going to call it Meta. If you go to the 886, this is still the kind of the scenario we have to see of going up, having a reaction, and then come back down for a secondary retest. Just by definition, before, if I was looking for an opportunity, this is the way to think about it. If I was looking for an opportunity in a stock like this, you have to go through months of price action, stabilization before this thing could even be considered an opportunity. That's not what you want to see. A great, probably a really nice position to sell calls against or continue to. Here is the other thing to be aware of that I said this yesterday. Every one of these big tech stocks, which is most of them, will need a full retest of their all-time IPO ranges. If it's Netflix or if it's Facebook, interesting how the all-time 618 on Facebook again matches up with the 886 of the COVID retracement. And this is the first level. I'm starting to more and more think about what happens if we do get the massive breakdown. I mean, I'm looking, okay, Dow just down 500 now. Nasdaq's down 350. S&P is down 70. And this is, where acceleration to the downside can continue. We know that the lows on S&P under 4,100, it's over. And the Dow and the other markets, another 1,000 or a couple 2,000 lower, you don't really. That's where the air comes in. Let's look at the diamonds. Here's Dow diamonds, folks. Okay, this is becoming a ominous chart, quite frankly, where this is the COVID low all the way back at 200. And I'm going to say that if we go into new lows for the year, and this is Dow, if the Dow goes to under, what's that, 30, basically 32,500, not another 1,500 lower, you're going to start to get this kind of minimum structural consideration where it's going to be an ABCD off the top. So that was a C point. And then you start to look at longer term retracements as minimum targets, like a 382 puts you at 30,000 at 300 on the diamonds. It is absolutely setting up where if we trigger these BAM scenarios, we trigger these breakdown scenarios, we take out the new lows. I'm thinking, now until September, October will be a very treacherous time. It'll be a grind, continue to grind lower, but it will start to really put a further dent into any kind of argument for a long-term uptrend. That's where we are. I mean, you're seeing devastation. Yeah, somebody's mentioning here about PayPal. We talked about PayPal going. I talked about PayPal going to 60. I don't think that's that. Just let's look at a couple of these big story stocks that are really not in a spot that even suggests to try to capture this knife. Here's PayPal. New lows. I mean, new lows, and not only new lows, but taking out COVID lows. That's PayPal. Here's the other one, which was IPO last year, Coinbase. And this should be a concern for all crypto. That Coinbase, essentially, they take it out at the high, take it public. Well, where can this go? Just do a 1618 and do your spread all the way down. Can that do a 1618? Sure can. Coinbase to go under 100? Easily. Do we see any patterns here? No. Do we see any kind of constructive price action on the weekly? Nothing. HSI still trending lower. Your daily chart, again, this is where the grind, the malaise comes in and just continues to take this lower and lower and lower. No pattern here. Nothing really to sink your teeth into. And these are some of the big stocks. And forget about your other kind of niche plays. Take a look also at, we did have a bat pattern that formed on the daily. Just gave us a reaction, barely to target one, and then straight through the hop. That's my concern for so many of these stocks that have gone public in the last 3-5 years and benefited from post-COVID run and the final phase of crazy of CE, crazy easing, not quantitative easing, crazy easing. And we find ourselves going to see what the consequences of all of this would be. It's just not, what it says to me is that COVID run was 100% fluff. And that was completely manufactured. This should have never happened. And when that happens and we can become aware of that, then we know we're dealing with something that is potentially paper thin. And that, for me, this is becoming more and more reminiscent of not 2008, but 2000. The 2000 bear market was a bear and a half for tech stocks. You lost 50% of your value. The ironic thing was that you still, a lot of the old money and your safety stocks, they held up relatively well. But you had a lot of IPOs that got devastated, and that's what we're seeing. Absolutely no opportunities here. Here's something I wanted to talk about. We mentioned it yesterday. We want to be looking for reactions within the downtrend and look for those opportunities that, all right, if that's our downtrend, which it is, then we want to be looking at these little thrusts every time. They're called reciprocal ABCD moves. That every little thrust, in this case, it's like every time Coinbase rallies about, 50, $60, it's a sell opportunity. And it comes right out of the book. Here's the volume 2 book. I wanted to show this today because I got a little bit into it yesterday, but again, we can look at these approximated ABCD, reciprocal ABCD moves, simply just looking at established trends and the first move within that trend and looking for patterns that are rather small but significant. And that's what this is really saying to me. I mean, I showed one or two of there was a bearish bat, a couple bearish patterns that I highlighted yesterday that had this very phenomenon. And this is from the Volume 2 book. It's available on harmonictrader.com. Again, go to Harmonic Trader, become a basic member, access all the books for free here, and then get the software. All right? That's the 2-second thing. But grab the software, and everyone should be on the TradingView program. I just think it's such an easy program to access. It works so well. And then I think for those that like to run multiple charts, multiple screens, I'm always running at least 2 programs, sometimes 3 analytical programs, and then I have an execution screen on the side. So get with all of that. But what I need to highlight is the simple fact that when we see these patterns fail, they break down, what do we expect? We have to stay with the trend. There's certainly no opportunity here on the long side. And so how low can it go? We bring up our spread of ratios. You look at the weekly chart is as ugly as it can be. And Coinbase is 128.50 currently. Folks, this another one could go under 100, under 75. Again, great concept, great company, love crypto, but at what price? What price are we going to do this? There's a lot of these that are continue to melt down like this. I wanted to show, what was the other one I talked about? Oh, well, here's one we talked about last week. Another big name that is threatening new lows is Goldman Sachs. And I highlighted the fact we had a beautiful pattern here. Again, earnings did nothing. Zero. Earnings were last week, pop and roll. And now we are so close, basically 308, under 308 will be a failure, will be a complete failure. And you step aside on something like Goldman Sachs and then get a little perspective on the weekly time frame, going back to your COVID low. There. Tell me where the 382 is. Right there, where we are currently. It's exactly at a 382 of the COVID low. What do we know? Well, interestingly, that it paused there, but not able to make any discernible move to go higher. And what that tells me is this thing is probably more in the midst of a 50 to a 618 pullback, which takes you as low as 245, 240, and you're currently 315. No opportunity. Zero. Here's the other one that we've probably as great of a narrative and everything that you would want to see uh, to really be a believer in the company is Tesla, and look what's going on, folks. Now, we talked about Tesla last week. The daily had this beautiful butterfly, and we were saying, nope, no long opportunity. If anything, that's a opportunity to get short. And in a type 1 reaction, which it is, we have reached and attained target 1 level at 910, now trading 898. Where can this go? As low as 830 on this run. Tesla has not registered anything yet in this zone between 910 and 830. We're hitting the oversold at the moment, but we know that's going to take a couple more days before that can hit the zone and pop out, before we would even consider it. The bigger takeaway, the post-earnings reaction is about as ugly as it can be. It really is, these kind of situations, when they come together like this, tell you that what way is this going? This is not going up. As much as people love Tesla and love Elon Musk, Tesla is in a corrective phase here. And this is a better one this is the kind of one where, take a look at the example. So look at this. This is an illustration. This is chapter 4 in the volume 2 book that was released back in 2007. And then the Financial Times version was 2010. This is the second edition, the 2010 version. Essentially, both books are the same. The Financial Times version, that's more what we did for the retail kind of a global distribution. I did an update on that, and but I still had this same strategy information of the trends and looking at this strategy of patterns within the trend. And the thing about it is that just like Tesla and a lot of other ones, you're going to see these things develop, okay, halfway down the trend where maybe it's difficult to really discern the significance of what that pattern is telling you. But when you are in that, if it's an intraday, which this was, here's Apple on a 5 minute, okay, and just take a look at the price action at the trend line top. That's the key. When it fails to break out of the trend, and we can look at Tesla, this is a daily. Pretty clear what this is, the behavior of this whole trend is telling us. Really nice bearish trend has taken shape. Another clear, distinct bearish continuation pattern. This time, just a butterfly, but we are threatening 830 at target 2, and the low end of that trading range of that downtrend does not come back to a full retest of the prior lows, basically 700. Nothing here. I mean, it's really can be troubling when you pull out and look at these long-term charts. I mean, Tesla's another one where I just think it's going to take some more time to finalize this larger correction. And there's the long-term uptrend. That's the concern with Tesla, is that you break that long-term uptrend, goodbye. And what I would actually anticipate and want to see in that situation is you got to give me some kind of ABCD long-term off the top. The ABCD is going to be our minimum structural pattern that is, some kind of formation. We're looking for some kind of construction off of this. So an ABCD here, or even an 886 of the prior swing, all of this is pointing lower. And until we get down there, not an opportunity. It's just cannot emphasize how strong these technicals, these harmonics are. Here's another one. I mentioned Disney a long time ago that we were looking for a pullback on Disney, and I would look down at that, basically the 140 area as low as 120, because we had this is weekly chart too, by the way, folks. We had this deep crab pattern, huge, and now on the first reaction, okay, and it really is a type 1 reaction still, because we never came back to, we hit target 1 and we kept on going. Now we're down at target 2. At the hop level at 115.90, we literally just hit that. So weekly chart, massive back-to-back formations, but what's happening here? At the hop level, we were, when we looked at Disney, and this is probably at the beginning of the year, we were saying, let this thing fall. Let's look for an opportunity against that pattern at lower levels. Well, now we're here. Now we're down at your lowest of levels that you could absolutely consider as an opportunity. And look what's going on at the hop. This is, actually, is this a type 2? Because there's your terminal bar. Your terminal bar hit on the crab back in January. And did we get to 157.44? We sure did. We did hit that. It's the placement of the lines. Here's a little hint for just if you want to make sure and double check. Your target 1 line is right there. Clearly that candle hit it. But look at these numbers up here, okay? That's going to give you your open, high, low. for that bar. The high was 157.50. So by definition, that is a type 1 reaction, and you are in a type 2 retest or type 2 return at the hop level all the way down there at 115.90. No, nothing to register it though. HSI still needs to come lower, amplified, deeply oversold. I mean, not even thinking about coming out yet. And then you've got earnings coming up on the 11th of May. Ugly action. That's ugly. That is about as ugly as it can get. And so if it's a type 2 and we're looking for an opportunity until HSI arrow pops up in this area, I'm not going to do anything with it other than look at this as a sign of potentially what could happen here, which Disney and the COVID low, 886 off of that, which let's start doing that a whole bunch, $94. That's, again, don't be surprised when we start to see other markets roll over and then you assess it relative to the COVID low, that it may seem a far distance away, but these kind of structural pattern formations, they do repeat. And we saw Netflix actually already violate it. Facebook looks like it's going to head a lot lower to test these levels. Nothing there. Let's go over to crypto. Let's look at Doge quickly because Doge was really interesting yesterday on that announcement and basically did what we thought it would do and rolled right back over. Um, Here's Doge. I'll get to the other ones. Remember what we talked about yesterday? Just looking for, and I was really just kind of trying to do a connect the dots, if you will, saying there's XA. What kind of structure do we have here? Well, we had a bit of a shark, but we didn't get to the 886. Your 1618 off of that in that part of the structure, yes. Our 886, which was about, what, 17 and a half, you didn't get there. Pretty close, but still affirms the whole thought that these are all reactions and they're going to have to go through, a series of stair step up, come back down, and then maybe what Doge will do later, come back down, trigger again, and start to go from these lower levels. That was pretty close yesterday, but it's not there. It's going to take a lot of time for that. The big thing about crypto that I talked about in the total crypto market cap, simply the fact that we had to hit the full retest on total. So here's total crypto index. Go to the daily. Remember the crab pattern. And this is another one where it's kind of a sneaky retest because where's level 1? We had that first thrust, but we didn't get to target 1. Then we came up to 209 with HSI, and now we're coming back for the full retest at 1715. 1715. Did we hit that yesterday? What was that low? Really close. I think you have to hit 1715. We're at 176 currently. And so think of it like this, that until you hit that 1715, yeah, we were at 173. Still down. Still down until we get there, and we would need harmonic strength index to come back inside, come back down this way for a retest. So even crypto needs time to resolve what's going on here. We've got to just, you're in a bad spot, folks. This is not a fun time to be a trader because we've already come down quite a bit. We're really grinding lower. You're not getting even great opportunities to enter shorts because of the type of action we're seeing. And she's, you're not hitting your levels. You're just taking a lot of time to do so. And that's when you really don't want to fight the trend, is my point here. Don't be trying to expect much from patterns that aren't able to stabilize or fail. That's a 5 minute. That's just from an hour ago, straight on through. I mean, it's a classic failure where, yeah, you have a bat formation, but look at the terminal bar right here. Let me highlight that. And it's just straight on through. No, really no reaction, no response. I want to look at the total, this is the wrong one, the total DeFi market cap. Total DeFi market cap, as we've been saying, has been the strongest of all three, or the four major indices. There's your monthly time frame. And this is, good to look at. It's excluding Bitcoin, excluding Ethereum. Look, that's my only concern with crypto. Can you hold these weekly, monthly trends? And this is also where let's go there, the monthly. Your monthly price bars are going to be critical. And this is, bring it under a little bit like that. The only consideration with the total crypto market caps is what was last month's range, and we better hold the prior low. You don't want to take out the lows from last month. And if anything, with a lot of the markets we're seeing, we had devastation in the first quarter, and now you're starting to see, at least in the stocks, you're continuing lower. And that's not a good sign when you're looking at weekly or monthly bars wanting some kind of turnaround. You're looking for some kind of stabilization. It's not happening. With crypto, well, we're going to see that within the monthly ranges. You're getting squeezed. It's certainly holding up, which is a nice sign. This is still in an uptrend, but if we start to take out 1, 2 month lows, that's when I get concerned. Much like the stock market with S&P, say under 4,100, or the Dow basically under 33,000, that's where you have much, much bigger problems. It seems like we want to get there sooner than later. Dow now down 550 at 33.5. So, we are getting to a point where you're risking the March lows, you're risking a breakdown continuation. And none of us have really been here for a long time. A couple of comments. Again, shout out. Thank you. Thanks, David. Appreciate it. Hey, Snipes. Hey, Meister John. Frothing at the mouth of the 600 Tesla. Yeah, again, some of that might seem crazy. I know, but listen, it's really important to understand that these scenarios, the way this stuff can develop, can take you down deeply in a severe downdraft. And sure, there will be opportunities, but we need to finish this. You have to think of it as a process, that we're in a corrective process. The market needs to show us some clear pattern formations with some distinct setup of divergence, and then finish it. Because a lot of times, people will jump the gun and think, oh, okay, as soon as that divergence happens, it's go time. No, it's more like a delayed effect, where a lot of the patterns we see that will take the better of 8, 10, 12 bars to completely reverse. If we're dealing with a weekly chart, then you're talking about finishing the formation and spending 2 or 3 months before you even start to turn around. Definitely need to be aware of this, just this whole reality, as you know, as unappealing as it may be, I think in a market like this, what I talked about last week of just looking for short-term trade opportunities, that's it. Become a trader. If you're not trading, folks, I would start to embrace short-term trading techniques because on the short side and the long side, your big moves, your lowest risk, your best risk to reward scenarios are going to come from those shorter term time frames. If we're going to have some kind of major bottom, there will be plenty of time to capitalize on whenever that materializes. This could get really nasty, or we could just have a devastating 6 months, wash it out, and then we start again. But all of this to me is at lower levels, unfortunately, and you're not there. You're just not there. The dollar, yeah, the dollars goes up. Maybe we should look at that dollar index. That's probably a lot of people have been saying that. Let's look at the U.S. dollar, DXY. Yep, here's DXY. Oof, 102. 102. That's amazing. That's the monthly chart, by the way. On the daily, I think we have no weekly time frame. Here's your weekly. Take a look. We're at the 886 off of the 2020 high. And again, COVID 886, right? COVID 886. I think that's a theme that you have to ask yourself if you're looking at a market or you're looking at something that's extremely oversold, where is it relative to the COVID low or COVID peak, if you will, COVID extreme? And that 886 is about to hit. Let's see what happens when we get up there because COVID 886 is basically 102.50 and you're trading 102 at the moment. Maybe we get a pause here, a 382 pullback after that 886 and go again. Kind of reminds me of crude oil from a few weeks ago. And let's go back to the monthly. There you go. So there's dollar index last 10 years. Pretty clear what happens above 104, 105. These are the levels that if they get violated, you're in price discovery for the dollar. What does that mean? It's where the acceleration will occur. I think let's take a look at the 886 because it's not necessarily how it gets to that number. It's what does it do at the number. And you're fairly close. Remember, when we hit the crude oil 886, it was a flash. And we were looking for a pause, and it got a smackdown. I still say crude oil is going to go higher, but it's going to take time because you're correcting that first big 886 swing. This could do the same, but there's not going to be any relief in that dollar index putting pressure on the market until something larger develops. These trends that started back in November and December are only accelerating, and there's apart from the last week of March and early April, nothing has really changed. And that's something where you need to recognize what that is in advance. Let's look at interest rates. Remember we looked at rates a few weeks ago. I really need to, we did a whole session on that, looking at the 10-year, looking at a lot of these formations. Here's the 10-year. Let's connect some dots. Remember? Okay, that's a 2018 peak, and you have a B point at a 50, C point at a 46, goes to the 886. which was hit. It was hit. Exactly, 2.96. There's a beautiful and perfect bat pattern. Look at it on the daily. Okay, there's the daily time frame. 886 is amazing. We're getting a reaction. I think that's an interesting development. When did that hit? Yesterday? Or 3 days ago? 2 days ago. 2.96 is the peak on that 10-year. At least that's something. Where can we see a brief respite in interest rates? Can we get a brief corrective pullback where the pressure of rates can stop being so hard on the market as S&P now down 80, Dow down 525, NASDAQ down 383. That's the 10-year. Let's look at, say, the 2-year. Oh, let me try that again. Actually, I think we were looking at the 30-year as well. Let's look at the 30-year. The 30-year on monthly is important to look at because of the long-term downtrend. Last time we looked at this, this was essentially, this is the monthly chart going back to 88. I think it's really good perspective to look at these kind of charts so you understand, are we in the start of something serious that would be, more threatening? You have to take out 370. Got to take out this prior high here. And then, remember, 6% is about the average long term, folks. I know that's crazy, but a 6%, even as much as an 8% 30-year, you have to go back to the 90s to get there. But when I was coming up and I was learning about this stuff, 6% was low. And once you got under 6, that seemed a little crazy. When you got down to 3, people thought that was insane. But that was, remember, not until the financial crisis did you get down there. Quantitative easing really started, the crazy easing, the reckless quantitative easing started there. All right, and in 2008, just to flash and give you some perspective, all right, S&P bottomed at 665. NASDAQ bottomed at around, NASDAQ composite bottomed, what was it, 1,400? The Dow bottomed at about 7,000. Just so you know, these last 10 years have been aberrational versus the historic norm, and we're threatening to try to break out of this downtrend. It will take quite a bit of time, but we know that every month, every week that we progress from here will only add fuel to the fire, if you will. Let's look at here's the daily. And if we go off the last pivot high, just like we did for the 10-year, we can assume that until we hit this 886, we're going to continue higher. Here, let me clean this up. There you go. So there's the COVID low, 0.7. 0.7 on the 30-year. And that really could be the all-time low right there. You come up. All right. Oh, check it out. Interesting. B point is at a 65%. Maybe 66. That's not really the kind of Gartley action we want to see. B point, if we were going to look at an 886, that's around 318, 315. But if a B point is at a 66% off of this X to A low, what does that mean for our Gartley potential? It does not fit really. Like a Gartley 786 would be right there. But what's the problem with that Gartley formation? It does not have an ABCD. It's just like a ratio Gartley. That's it. Really nothing there that, from a structural perspective, that would tell me that's a short-term bearish pattern. It doesn't line up properly, and that happens. That's okay. We might get a pause. We might get a little reaction here, but um, what I tend to see in these situations, when you get a B point at a 66% and you break out, that will morph as like caterpillar to a butterfly, basically change the animal behavior, not a Gartley, not a bat. It goes to become a crab. And that goes to a 1618 extension. We saw this in nat gas way before the big move in nat gas. We're seeing it in some other measures that we looked at recently, that we start to go stronger in this interest rate scenario. We're seeing the markets break down. This is the malaise, folks. This is when the malaise, you feel it. And I've been talking about the malaise for a while. But after a pause, if we don't see any clear developments here, then as this kind of continues, we have to project it higher. I mean, it's not what you want to see, but it's just kind of, this is where connecting the dots really helps, because we get to understand that, say, okay, this is a different creature. This is not it's not your old time Gartley. This is something where it's mm, ugly formation, ugly kind of alignment of ratios, that if we get another month or two and we find ourselves, just checking up above 3, above 3.1, 3.2, to shoot this gap from the B point, which is 250, which I think is now the floor. I don't expect this to go below 250, that we shoot the gap in a short order in maybe a crazy fashion like we did down to the low. I mean, look, the COVID low took about 6 weeks, and you went from the 194 all the way to 6.6, 0.67. All right, we're almost at that point now where, on the flip side, rates start to tick up and keep going. Your 1618 target, a 5% yield on the 30-year, is at stake. Not going to happen right away. And again, this is something that could develop over the next 8, 10, 12 months. But this is not stopping. And again, that's where the malaise, the destruction of equity values really starts to hurt. And I mean, first you take it out of the tech, then you go and you get the other ones later. And we're seeing that. Look, devastation in Netflix tells us something is quite ugly. Here's one or two more. Here's Microsoft. And this is also the point where, when the market starts to accelerate lower, you're going to see the generals fall. You're going to see Apple. You're going to see Amazon. You're going to see Microsoft begin to give it up in a big way. NASDAQ's now down 405. S&P now 86 lower. Today down 2%. Ugly stuff. This is, again, hate to be like this. We always want to see a nice, smooth, trending market, but we haven't had a correction in a long time, and we're in a full correction mode. It's just, where are you going to hide? Where are you going to wait this out for the next 6 months? Hate to say it like that, but that's where we are. It's why I think the holding of anything right now is going to be a real problem. Unless you're short, and even if you're short, you're going to see massive swings like we saw yesterday. Yesterday the Dow rallied 700 points. Now we're right back down to those lows. Microsoft, I think, is probably the closest one versus Apple or Amazon. We know the FANG is dead, by the way. If you didn't know it, FANG, as in Facebook, Apple, Amazon, Netflix, Google, that is disintegrating. That's like the four horsemen from the 2000 bear market, the four horsemen that everyone, rode the tech wave on, which was Microsoft, Dell, Intel, Sun Microsystems. Those were your four horsemen of that era. Well, the FANG is that equivalent. And the FANG, okay, Netflix is dead. Netflix is done. Throw that out. Uh, Facebook, that will be next. Google, not doing well. Apple, Amazon, probably the last two to ride. Microsoft, because Microsoft is both a Dow component, S&P component, and a NASDAQ, all three, this is probably the one that's, once Microsoft starts to fall, that will bring the other indices lower. And let's just get a monthly perspective on Softy here. There you go. Here's our long-term trend. Monthly chart. There's your, okay, that's your 5-year uptrend. Tell me what it's doing. What is happening at this trend test? Also, another great example of looking at a monthly candle. Tell me what it's doing versus the prior monthly range here. Under 270, kids. You got real problems. Under 270, under that trend line, in this instance, you start doing all-time retracements. Where's COVID low? First COVID low? Doesn't look like much, but let's just start there. The COVID retracement possibilities, you're at your 382 is essentially what is 270 area. Full 886 pullback of the COVID low goes to 150, 160, 155, and I think that's possible. Under these lows. Under 270 on Bitcoin, no thank you. And if we go to say a 5-minute chart, which is what I think everyone should be doing at this point, look at all these bearish patterns. And I would just be favoring bearish patterns. We're working with Harmonic Pattern Collection. And I'm not, if we do the top-down approach on all of our markets, they all look ugly. They all are in major retracement phase. They all look like they got to pay the piper for COVID and come back down, which is, I mean, this whole environment of everything you have right now, folks, whew, it's you put the pieces together, you couldn't have a more bearish scenario. For me, I just have to call it as I see it. A couple of comments. Another shout out to the chat. Thanks everybody. Appreciate the tolerating of the nasal tone yesterday and today. I should be cleared up by tomorrow. I am brutal. What's up, Robert? How you doing, Mr. Lifeless? Good to see everybody. And you got it. You're looking to chart the Victoria. Great comment, Victoria. So Victoria was talking about GE. GE's down nice 10% today. Hold on. Having a problem with my... And I'll look at that because I think that's a great example of long-term harmonic. So she said she noticed that GE did an all-time 886 retracement on its monthly. And remember this? Look at GE. And I think this is a good story stock because GE was one of the darlings of the 90s. And this is split adjusted too, by the way. So it didn't really go to 450. It's just that on this crash in 2008 was so horrible that almost went bankrupt that they did a reverse split. And then you saw the massive bat pattern. Yes, that was the 886 all-time retracement. And I think you can start looking at these older stocks for examples of what happened after the massive 90s run. And again, COVID and the Y2K scenario are almost identical. You had a very similar narrative. You had a massive liquidity injection for a short-term problem that was resolved within 18 months, 24 months tops. And once that was over and that liquidity went away, you had to pay. And for GE, when we topped out in late 90s and went into there was your first bear market move to a perfect 618 all-time move. But that was the all-time 886 at the low that she was referencing. I don't look at these type of stocks enough, and because there's a lot of information, there's a lot of great historical example to apply to this market of what's the potential. How bad can this get? Well, yeah, we can do full 886 retests. We can do full whatever that original uh, impetus was of what was the Y2K run up from basically 1998, 1999 into 2000. That completely was retraced. This one on the monthly had a beautiful bat pattern, hop level now back in play of a retest where you had a type 1 move that took you better part of, amazing, 6 years to realize up to 237. And then look what happens when it hits 237, full rejection back down. And this is GE is another place I would not want to be. GE probably comes back and retests the lows at, 58. You're 80 at the moment. This is what can happen. And not to mention the darling stocks of your last bull market become your poster childs for the bear markets, and GE doesn't recover. That's the problem with, say, a Netflix. And I'm serious here. If this is Netflix, okay, Netflix is breaking this prior low, wanting to go to the 886. If Netflix is there, Netflix is trading, I don't know, 200 or 180, and we're saying Netflix is going to 50, that's 50. And it does it in this kind of fashion. Look at that bear market from 2008. And I don't mean to be dramatic here, folks, with, now S&P down 90, Nasdaq's down 416, Dow down, oh, I don't know, what, 600 and change. This is what happens, and it goes pretty quickly. This is November, October '07, hence October, November 21. And then by early '09, 15 months later, you lose, you realize that full 886 reset. But more importantly, you drop like 80% off of those levels. Hate to say it, but that's where we are at the moment. That's why the deeper we go, the more concern in terms of this massive corrective move becomes apparent. And again, I just got to stick with this. Very great comment though. Thank you. A couple more. Ay, ay, ay. Yeah, excellent. Couple more. Let's go to. Let me go to something that I wanted to highlight, which was I wanted to show U.S. inflation. So really quick, this is something will come up pretty soon. Where is that? Oh, it's the economy. Here you go. So year over year inflation rate. We are going to be coming up on another reading in a couple of weeks after last month's 8.5%. And this is, again, where we want to connect dots. Tell me where the larger trends are going. If we're We're in an inflationary trend. Interest rates now picking up to try to accommodate for this massive surge, and you're in the middle of the move. I would look for this inflation year over year. If we just connect dots, look, we've got a shark pattern. I mentioned this before. We can do this loosely, but it's a way to target your major metrics of if inflation's going to run, how far is it going to go? If interest rates are going to keep moving, what are the possibilities there? We apply the same harmonic pattern framework, connect the dots in the same way as we do here, and with this kind of shark pattern, up at around 13%, I would say that's a possibility you have to consider sooner than later, especially with every month going higher and no abatement to this move. Also, we're in the middle of a surging kind of situation that, oh boy, it's the absolute antithesis of last year. Last year was probably the peak on the whole cycle. And the way this is coming off of those lows dictates this type of consideration that this trend, this surging thing that started a while back won't stop. And that's going to press equity prices. Our goal here for the next couple of weeks is to basically determine where this is going to break down, where the larger moves are going to absolutely start to trigger acceleration. Here is one instrument we're going to come back to more and more, and I think it's something where it's probably more tradable than anything else, and that is this SQQQ. So SQQQ, let me get that on the daily. It's been a while. We started to play this. Oh, get back here. We played this towards the last October. We had some patterns. And this reminds me a lot of Boyle, folks. Let me fix that. This is the ultra short QQQ. Get back here. And they did have a split on this. Now, what I want to highlight is the fact that we had a retest of this Gartley back in, what was it, March. And we now have this thing where you're breaking out above target 2. And we'll see how high this will go. This reminds me of Boyle. Boyle for natural gas. It's another one of these like obscure, kind of just not, this trades a few 100,000 shares, might trade 1 million on a day. But the fact that this SQQQ, it's a bearish ETF, has shown us a really nice pattern is something I want to watch, that if this gets out of control, gets above 50, 52, starts to break out, that means the broader market, will then do the acceleration phase. Here's the 4-hour chart on the Gartley, and that's a type 1 on the Gartley. Now, this is what I'm looking for. We're coming into May. Next week, seasonal trends are going to really be important this year. So we know the historic returns. Why do they say sell in May? Because the historical gains are made generally from November until May, and then the market underperforms from May until October. That's history. If we want to play this, we're looking for an instrument that will go inverse the market. Basically, we think the market's going to go down. Well, let's look for this to come back, retest the Gartley. That's what I would look for. And then maybe it develops in 2 or 3 weeks for the larger move, the 2 of 2 move, if you will. Because if we get to the 2 of 2 and then the market does accelerate, our targets are much lower. No doubt. I want to be clear on this. This is not a wishy-washy statement here. We are that close to we're going to violate some critical levels and then forget about it. You step aside. It's going to be like the Netflix thing when it broke down and then broke down again last week, and you throw in the towel. I throw in the towel on Netflix. I wouldn't touch it. But Netflix also shows us what can happen in these kind of environments. I hope it doesn't materialize, folks. There's, some kind of saving grace, but let me circle back and I'll finish up where we started here. Let's go to Tesla. Now down 100. Where's Tesla going? Down 110, folks. Where's Tesla going? Well, pretty clear here on our 4-hour chart. We're going to go back, retest that crab pattern. Let me clean up the chart here. Let's remove all these lines. But Tesla has a couple of patterns, crab patterns, basically 730, 700. That's where it's going. The daily time frame, just look at your 886 now. Now look at that butterfly. 886 of the March low is 740. And this is a well-established downtrend now. Really tough. So I would need to see some kind of bullish pattern develop here or a successful 886 retest before I would even consider this again. And I just step away from Tesla, step away from a lot of these. Even Twitter, I mean, he's going to buy it out at $54. Twitter is acting terribly. And it's rejected right off of target one. Again, we talked about that yesterday as well. A lot of issues here. When we put the pattern framework against these levels and we look at how things are materializing, we absolutely have an issue with where the market is. I have an issue. And it's not in a spot that suggests anything but down for now. And again, I'm not trying to hammer on top of a obvious bearish day, but it's I said this yesterday that Friday was devastating. Friday was technically devastating for so many markets, and we see the follow through yesterday and today that it's troubling. So, step away, folks. Don't take it for what what it's worth, but uh, from here on out, probably from now into this summer, I'll be trading, and I'll probably be trading to the short side, and I will be short-term trading only. I will be looking for opportunities in things like energy. I do think that oil will have another massive opportunity coming up, but it's not there yet, and that's about the only sector I see. We get into this unique time. We have to get a little creative. And that's where things like the SQQQ, if you haven't looked at it, let's start getting it on the screen. And I'm not saying today it's a buy. I'm not saying just jump in there and, look for this to explode. But this does remind me of the ETF, the Nat Gas ETF Boyle. And it's early in its development. And let me just, for reference sake, remember Boyle? Okay, nat gas is up again big today. Energy continues. Boyle, look at what Boyle was. We talked about it. Boyle is probably ready to go back for the return. Look at the sessions from last week and the week before. Basically, we were looking as this was getting up to 90, 95. Essentially, the 886 off of that prior swing, we're saying let's take some profits. All right, because it had a reaction. And nat gas is up nicely again today. Let's look at 78.87 or just underneath there for the return move. Now, for perspective, relative to, say, the SQQQ, here's Boyle, and it was a monthly chart, pretty sure. Monthly? Let me see here. I think it was on the other, maybe it was on the eSignal platform. We had some bullish patterns. Oh, there, yeah, on the daily here. Down here on this last corrective move, we had some, not only at the 22 level, and then we had this big bat pattern. That was the most recent. It was pretty remarkable, but that was the most recent pattern there at your 886. And it moved, what, 300%? Pretty short period of time. That's what these ETFs do. And these are the ones I will be looking to trade. If the market's just going to continue to bleed, interest rates still have a ways to go, crude oil doing what it's doing, and equities are going to continue to grind lower, we will get plenty of opportunities for those to come back, give us another opportunity to go. Other than that, other stocks, other looking for opportunities in these dramatically damaged tech areas, no. I don't think so. I think we need to, across the board, retest March lows, or give us some patterns over the next couple of months. Just not in a great position, folks. So let's come back on Thursday. I appreciate the time. Thanks, everybody, for being patient with me. Come back next Thursday. Or no, come back Thursday. And yeah, UVXY. Let's look at that on Thursday, Ziggy. UVXY is the volatility ETF. I think these are the kind of instruments we need to look for in the next 3 to 6 months. Just the final note about, there's just so many things about this year, the second year of a presidential cycle, midterm elections. If you go back historically, look at market returns during these 6 months. They're some of the worst of the decade. Those are things that I know just from studying, looking at market cycles. We are, not that that is just an independent decision, a variable that you make a massive decision off of that, but you respect it. We respect the historical underperformance from May till October. And in the same way, on a longer annual cycle or decade cycle, even the second year of a decade is the worst. If you go back to 92, 82, 72, 42, those were bad years. So understand that this is just going to have to be a storm that we weather. We're going to have to look at other areas outside normal trading vehicles. And again, it's why I say for crypto will get clipped, but I don't think as much. Again, it's a time over price thing. So let's come on back on Thursday, folks. Thanks again for patience, time, quality of sound. Hope it was quality educational content. And we'll be back, I don't know, probably noon at this rate. That's what's working for me. So until then, thanks again. Have a great day. Go get 'em. See you Thursday.